This call is now being recorded.
Hello everyone. Once again, welcome to Kleiner Campus Tour. Here we're going to be teaching you, showing you the pathway of becoming an expert trader. So you might ask, who where is Kleiner? Well, Kleiner is an edtech company dedicated to empowering individuals with the knowledge and skills to understand and navigate the world of Web3 and digital currencies. Our mission as it stands is to simplify digital technologies and make them accessible to everyone, regardless of their prior experience. Here at China, we provide clear, concise guidance and actionable steps to help learners make informed, smart, and safe decisions in the rapidly evolving digital landscape. We're here to introduce people. We are your foundation steps. We're here to take you every step of the way from foundation level to expert level because you don't just dive into what you don't know, what you're not familiar with. When you end up doing that, you end up risking a whole lot, losing a whole lot. And we're here to ensure that that doesn't happen to you. So moving on with the curriculum of today, our contents. In today's campus tour, we're going to be touching each of these topics from technical analysis, support, demand, resistance, supply levels, or you know them as key levels, candlestick and chart patterns, leverage, lot size and spread, risk management strategies, buying and selling on the Forex markets, and balancing potential gains and losses. You might ask me why I said buying and selling on the Forex market or the commodity market because we have broken down the trading class into two sessions, one for cryptocurrencies and one for foreign exchange markets. So follow me as we dive into technical analysis in the Forex market. Today, we are going to be learning how to use some of these tools displayed here on the screen since we are dealing with Forex, excuse me, since we're dealing with Forex, we're going to be making use of our Meta 4 or Meta 5 trader. We're also going to be making good use of our trading view. So you might ask yourself, you might ask me, you might ask people, what is technical analysis? Well, technical analysis, as technical as it may sound, is just technical analysis is a trading method that uses historic price data. That's just technical analysis. Technical analysis involves using historic price data to predict future price movements, whether in financial assets like cryptocurrencies, the stock markets, or the foreign exchange markets, instead of focusing on companies' financial health or the overall economy, like in fundamental analysis. Fundamental analysis is the direct is another thing entirely different from technical analysis. When we talk about fundamental analysis, we talk about current news, the health of the company, what's going on, what are they manufacturing, what's their cash flow, and all that. So, but in technical analysis, we look at the price charts and market patterns to identify trading opportunities. Each of these analysis types of analysis actually have its advantages and has its edge in the markets and has a role to play when doing general analysis. So, but for today, we're just going to be diving into technical analysis, which involves us taking a look at our price charts. In technical analysis, we have key components. There are key components of technical analysis, and first of all, one of the most important is your price chart itself. The price chart is a wide grid, it's a page filled with different You can have different setups actually. You can have different types of candlesticks. We have the bar charts. We can have different types of charts actually. We have the bar charts, we have the candlestick charts, we have the line charts. So experts have what they use. Experts like me, experts like you are going to become. You're going to get used to different price charts and you're going to find out which of the price charts actually works for you. But today we're going to be teaching you the candlestick charts. Then we have the key levels. What are your key levels, you may ask? They are nothing too technical. Your key levels involve your areas, the areas on your chart where you see price bouncing or reacting from. And when we talk about key levels, we have the support and the resistance level. Your support level can also be known as your demand level and your resistance level can also be known as your supply level. Why do these levels matter actually? Because when you see price at when you see price actually approaching these levels, you tend to see a reaction in price. Either price momentum slows down in order to react and go in the direction which it has gone in the previous trend of the market. So these levels, these demand and supply, support and resistance levels are the key levels in the market where traders look to buy or sell. If you are a trader, price is approaching your demand or your support zone, you are looking forward to buying. You're looking for buying opportunities. Then when price is approaching your resistance or your supply level, you're looking forward to sell. So next key component of technical analysis we have is the trends, market trends. We have two types of trends. Rather, we have three trends, but two most importantly, the two common trends you see, we have the uptrend and the downtrend when markets. We're going to dive into the chart and we're going to take a look at all of these. So, but for now, this is just me explaining. We'll still dive into further explanation in our charts because today is going to be a very practical session from placing trades and to question and answer sections. In case there's anything you don't get clearly, you can also feel free to fill the form my colleague is going to drop in the chat box, and we look forward to hearing from you. So, market trends, we have the uptrend and we have the downtrend. When market goes up, moving in moving in a trend like moving in a pattern upwards, we call that an uptrend. When price is breaking, okay, yeah, let me explain it better still like this. When price keep making higher highs and higher lows, like price tend to break towards the upside, keeps on breaking towards the upside without any change of breaking downward. We call that an uptrend. Then we also have the downtrend. The downtrend, this is when price forms lower highs and lower lows. Price tends to break towards the downside. So we're going to actually see more examples. We're going to see examples of uptrends and downtrends. And we also have a consolidation trend in this kind of trend. The markets, the market in this type of trend, the market just keeps on moving around a certain zone, up and down. It doesn't break toward the upside, it doesn't break downward, it doesn't break upward or downward. Then next one we have the chart patterns. Chart patterns. These are previous previous how will I put this now? These are previous modes of candlestick formations. There are certain ways candlestick form. We have different chart patterns. We have the ascending triangle, the descending triangle. We have the pennant patterns. We have the wedge patterns, and so many more. And a lot of people, we have the cup and handle. We have the flag, bullish flag, bearish flag. But some people actually specialize in trading chart patterns, and not until they see that chart pattern they don't enter any trade. So here in trading, in technical analysis, you have to get your edge whereby you find what works for you, because support key level traders make their money. They know how to make their money. Trend traders know how to make their money. Chart pattern traders know how they make their money. And these three types of price movements, when price reacts from key levels, when price is going up and down, up in an uptrend, down in a downtrend, or you're waiting for candlestick patterns to actually form in the market, each has a particular edge, and it- everybody has their specialization in trading. So next on the next key components we're looking at is time frames. Time frames. Yeah, we have different time frames on our charts. We have different time frames, from the weekly time frames, from the monthly time frame, even the yearly time frame, from the yearly time frame down to the 1 minute time frame. So usually we have two types of traders. We have the swing traders and we have the scalp traders or scalpers. Scalpers, they work from the 1 hour time frame down to the 1 minute time frame, execute their key levels in the 1 hour time frame, and they identify their trend also in the 1 hour time frame, and they find their entries in the 15 minutes time frame. Then the swing traders were the traders that analyze right from the weekly time frame down to the 4 hours time frame. They only use the 4 hours time frame for their entry and nothing else. So you tend to see that these two traders, the swing traders, they actually spend more time in the markets trading. Their trade could be open for weeks, for days. But for the scalpers, their trade can only be open for like an hour, 2 hours, 4 hours, maximum half a day, and they're in and out of your trade. So it's up to you to choose what kind of trader you want to be. Well, I've come to see that in trading, patience is the key, and whether you like it or not, when you identify these two type of traders, the scalpers and the swing traders, the trader with the most patience are the swing traders. Then we have another key component of technical analysis. We have indicators and oscillators. Indicators, they help us with price confluence when analyzing the markets. We have different type of indicators. We have the RSI, relative strength index. That's the full meaning of the RSI. We have the volume indicator. We have the sessions indicator. We have smart money concept indicator and so many more. Bollinger Band, moving averages. They are all we are all going to take a look at that later on. So another key component is volume analysis. Volume tends to measure the amount traded, the amount of money traded. Whether you're buying or selling, money is being moved. You're selling, money is being exchanged. You're buying, money is being exchanged. So we tend to check the volume of each candlestick. Each candlestick actually has volume. We have the impulse candlestick, which tend to have the highest volume. That is, you just see a very big candlestick either in the upward direction or in the downward direction, and we'll take a look at that. You might ask why technical analysis is useful. That you might ask. Technical analysis is actually used for identifying trends, which help you catch big market moves, for timing your trades, which show when to enter and exit a trade. Like we talked about time frames. Time frames are very important because you use time frames. You can't just enter a trade viewing on the weekly time frame, because for something you should know, each candlestick in the weekly time frame has a percentage. One candlestick in the weekly time frame can represent about 20% increase or decrease. In the forex market, it can represent maybe about 50 pips, sorry, about 500 pips or above. And when you learn about percentage increase or decrease or pips increase or decrease, you tend to know that your when placing trades, you have a risk reward system, and that's your risk reward ratio, whereby the amount of money you are trading, if you're putting in case the trade goes against your direction. So, and most times that's called your stop loss. Your stop loss has a minimum amount of pips. And for forex traders, you've heard a lot. Probably some traders, their stop loss are up to like 10 to 30 pips. And you wouldn't want to just enter a trade in the weekly time frame, because you wouldn't know where to place your stop loss or to place your take profits. So that's the use of different time frames. When you go break it down into lower time frames, you actually say, okay, identify the key levels in, let's say you want to swing a trade, you enter from the 4 hours time frame. You start from the weekly time frame, then go down to the 4 hours time frame. You identify your key levels, your support and resistance. Okay, you decide to place your stop loss above this key level, which is a resistance, knowing that okay, when price gets here, it doesn't go above, and there's this candle I'm seeing here, this rejection. It's not meant to come back and sweep anything that makes it come back and sweep this candlestick. That means the price has gone against my initial direction. And also we have risk management. Risk management help you set stop loss levels and profits targets. This was what we were just talking about. Then down to confirmation. Why technical analysis is useful. Confirmation entries are done with your different time frames. They are done with your candlestick patterns. They are done with your indicator, your technical indicators and oscillators. So by the time you see, let's use the relative strength index, for example. In the relative strength index, there's what they call overbought and oversold. When price is currently in that overbought layer, let's think we'll soon dive into the charts so I can show you a distance. Uh, sorry, give me a second. Okay, okay, this is the forex market charts. Let's look at GBP USD. Okay, here in GBP USD, this is your RSI indicator right here. Here, this purple zone. Sorry, give me a second. Here in this purple zone, we have the relative strength index, where the purple signifies the, here we're looking out for this purple color, this 75.15, this 75.15. Okay, so we have two areas actually. We have the area of overbought and oversold. And how do we identify these areas? Let me take our line. Okay, so when you see price above 70, this 70 here, 70 is identified as overbought. When it's above 70, you identify it as overbought. Then when it's below 30, take a line and go below 30. Let's say here. Okay. As you can see, your indicator has its own key levels. This 70 is a key level for overboughts. When you see price overbought, you do not want to enter any long position, you do not want to buy, you do not want to buy. You're definitely going to be looking for like price retracements down back inside the zone. And here we have your oversold, which is below 30. The chart might look like yes, price has actually gone above 70, and if you see yeah, price actually did reach 80, but the range, if you can see how price has been reacting so far, whenever it gets to this 70 range, you see price reacting, coming back downwards. When you get to this 30 range, see price coming back upward, and this 30 range is your oversold. You want to see price once price is oversold, you want to be buying. Once price is overbought, you want to be selling. So it might it might look so simple, and the chart might look like it's not actually following because of these fake outs. That's what they are called, because no trading no trading techniques is actually 100%. That's why you need patience. Yeah, actually stuff people wait to look forward to seeing before entering this trade now. And we're going to dive into more of that. But I just wanted to identify this range for you. You're overbought and you're oversold. You are looking for sales or price retracements when price is overbought, and you're looking for price retracements for buys when price is oversold. So going back to, excuse me, going back to confirmations. Okay. Uh, yeah, back to support, demand, and resistance, supply levels. So now we're going to be talking about support and resistance levels. We have mentioned it previously, but here we get to explain it, break it down, because we're going to be taking our time to look at each and every one of these things. So support and resistance levels in trading charts, where the price of an asset tends to pause or reverse in its direction, like we talked about previously. Price tends to bounce, react, have a reaction when it gets to that place. These levels are crucial for traders because they often indicate where buying or selling pressure is likely to increase. You're looking as a trader when price is reaching your demand zone, your supports, you're looking forward to buy. When price is reaching your resistance, which is your supply level, you're looking forward to sell. So they're really critical points, crucial points in the market where traders are looking forward to trade, creating potential trading opportunities. The support demand a price level where demand for an asset is strong enough to prevent the price from falling further. Yes, this explains it a lot. When price is approaching your demand level, this level is strong enough to prevent price from falling further. But here's the truth. You can actually identify your demand and supply levels. And you see, yeah, price got there like two or three times, reacted from there. The fourth time it got there, it broke down, it didn't respect it, and you're confused. You're like, is this actually a support? Isn't it meant to always react when you get here? It does. Things like that actually happens. The market isn't 100% efficient. The market isn't built for, if trading was that simple, a lot of us will have money. So what is the key thing here? You want to look for your patterns that occur at those regions, at that supply or that demand level. That's why you need to be patient as a trader, because usually price manipulation happens a lot. So when price tends to get there, you see that okay, price is not stopping. Price is still coming down. It's supposed to stop here. You think your line is going to hold price back from pushing, but price pushes below your line, and maybe you didn't actually wait for a confirmation before you enter your trade. Maybe you just entered, immediately touch the line, and you come back and say you've been stopped out of the trade. Not that that demand level wasn't respected. What stopped you was your impatience, and you don't just use one thing to confirm your trade. There should be other things you're looking for to see on the chart, like your chart patterns, your candlestick patterns when price is at your key zone. Whether price is above or slightly below that level is still valid. The level isn't just a line. from what we have learned so far, from what I've learned in all my years of trading, the line isn't the region isn't just a line, it's a region. It's a region. So you placing your line and seeing price fake out, because that's what it's called. Because after price stops you out, price tends to enter back in and respect that demand or supply level. So patience and extra confirmation is key when it comes to trading. Your resistance or supply level, a price level where the selling pressure is strong enough to prevent the price from rising further. It acts as a ceiling, holding the price down. Okay, we'll look at that. So right here, we have the horizontal support and resistance levels. Here, we have the flat price levels where the market has repeatedly bounced from. This is an example. Yes, this is an example. We have this chart right from our BTC USD charts, and this is in the daily time frame. So here we have this region acting as a demand zone, sorry, as a supply zone when or resistance level. When price got here, you saw the reaction, it came back down. Price got here again, came back down. If we should visit the chart, we'll see previous times where price actually got here and went back down. Then there's something you see while identifying this level. You see a demand zone become a supply zone become a demand zone. And this is an example of it. This supply zone becoming a demand zone when price broke up above it. This is exactly why you do not enter without confirmation. Price broke up above it, came back to retest, and if we zoom in, we see price reacting and not once but twice and taking it as a demand zone. So okay, back to then sorry, we have our trend line. We have our trend line support and resistance, which is a diagonal level that forms during trending markets. Actually, what we're talking about, we have the uptrend here, minor uptrend, and we have a downtrend here, all spotted in our BTC charts. This is an uptrend because you see price breaking upwards, forming higher highs, lower highs. This like this a higher high, this a lower high, higher high, lower high, price breaks again, and so on. Then in our downtrend, we see price breaking downwards, forming the higher low, lower low, higher low, lower low, and continuing for some period until there's a trend change, which we'll discuss about. Moving on to our indicators. There are times where we see our indicators, like I showed you previously, the relative strength index acting as having key levels, the support and resistance, demand and supply level. The supply level was above 70 and the demand level was below 30. So now moving averages, support and resistance, these are dynamic levels created by moving averages, which act as support or resistance rather, depending on the trend direction. So right here, we can see this is a downtrend and this is our moving average. We have the 25-day moving average, the 80 days moving average, the 100-day moving average. So right now, this indicator, this line you can see is our moving average. And if you notice, there are some points where this moving average act as support for the price. Like right here, it acted as a support to buy. Right here, acted as a support to sell, and okay, rather it acted as a supply zone, a demand zone. But when looking at your trend. You want to trade in the direction of your trend. So right here, you would only be taking sells, long-term sells, short-term buys, because buys do occur, but that's another aspect we're going to dive into further into in our cohorts coming up June 6th with our mentorship program, explaining further details about different trading techniques. So here we see price intercept with our moving average, and this right here acts as a supply or resistance level, and you see price reacting downwards. Same thing here, but here we had a fake out. But when price retraced back in, when you find your confirmation, price respected it and continued. So right here, we are looking at price, the moving average acting as a dynamic support or demand region for the upward movement, for the uptrend. So here, price reacted and it bounced up, creating a higher high and a lower low. And same thing happened here, if you can see it. So we're going to be looking at all this more in our charts later on. So moving on, why key levels are important in trading. Successful traders base decisions on research, not hype. This model teaches how to identify strong market narrative and analyze data, because whether you like it or not, this price, this candlestick charts that we're seeing here represents buyers' emotions and sellers' emotions. There's a lot of buying and selling going on these charts, similar with this. So entry and exit points, why key levels are important in trading. They help you identify your entry and exit points. They help traders identify where to buy, which is at the support, and where to sell, which is at the resistance. Sorry, excuse me. They help you in risk management, setting stop losses levels just below support or above resistance to reduce risk. They help with your psychological significance. These levels often reflect the collective emotions of traders, like we talked about previously when I went back to the chart. Here, whether you have the color of your candlestick can be any color you choose, but there's still going to be one candle representing going up, price going up, and one candle representing price coming down. So when price goes up, you see emotions of traders. When price comes down, you see emotions. Your chart is filled with different emotions. We have two emotions that there are four traders in this market, and we have the emotion of fear and greed. So yeah, they help with trend confirmation. Why key levels are important in trading. They help us with trend confirmation. Breaking a key level can signal the start of a new trend or the end of an old one. So yeah, when we saw price here breaking upward and retesting this zone and using it as a region for demand, we saw the end of this zone as a supply zone and the beginning of this zone being used as a demand zone. Okay, moving on. Okay, let's take a look at our price charts in trading view before we come back here. So I can identify something. This is going to be a very practical session, like I said before. So now we spoke about time frames. This currently, this is TradingView, one of the tools we are going to be using today. And in TradingView, we have our time frame. We have our, let's start with, uh, this is a watch list where you add the currency pairs you want to trade. But right now, I added all this for the trading session for our campus tour. Here, you can see the pairs I named it watch it under the currency pairs because when you're trading Forex pairs are called currency pairs. We have the USD pairs, which can be Euro USD, GBP USD, AUD USD, GBP representing British pounds, Euro, EUR representing Euro USD, and AUD representing Australian dollar. We also have the gold. We have the gold charts, and a lot of people when they start their trading, they start trading with gold. Okay, so let's take a look at gold charts today, and let's start. This is your time frames. I told you we can have from 1 year. This is your 1 year charts. What do you want to trade here? This is why we have different time frames actually. This is your 1 year charts. As you can see, so few information. The more information you see on the charts, the better for you actually. Better for you. So then we have our 1 week charts. We also have the monthly charts if you'd like to see that. We have the monthly charts. Let's see the monthly charts. This is the monthly charts after the yearly charts. All you can see here is price moving upward. This is an uptrend in the monthly charts. And why is this an uptrend? Let's pick our tool. I would like you to familiarize yourself a lot with TradingView because this is your home as a trader. You can see this. You can see this from all the way from here. Market started moving upward, making from here all the way from down here. Price has been moving upward, forming. Sorry about that. I just want to identify what you see in an uptrend. You see a break upward. That is your higher high, your higher highs breaking upward. Sorry about that. That's your higher high, another higher high. This is in the monthly time frame. We can go lower and still see an uptrend. So this now is your higher low, higher low. So price forming higher highs, higher lows, higher highs, higher lows. The previous low is higher than the previous high. That's why it's called a higher low. So this is an uptrend. Let's look for a downtrend here. We can spot this here as a downtrend. Yes, we can see a downtrend here because why market is trending downwards. Look at the direction. It's very easy to spot. Very easy to spot. See price going downwards in direction. This was a fake out. You'd be waiting for a confirmation before you don't just trade at these zones like we said previously. And we're going to look at more trading techniques in our upcoming must in our upcoming mentorship program in June. And here, okay, we've not reached candlestick pattern, so I can't start showing you the candlestick pattern. So for now, we have the uptrend and we have the downtrend. Then let's also identify supports and resistance levels, key levels. For that, let's go to a lower time frame. Let's go to the 1 week time frame and see what we got there. Excuse me. Okay, let's take a look at this region right here. this region in the weekly time frame. If we break it down to the daily time frame, we see it clearly for easier view. Okay, you see that when price comes here, it tends to react. This zone acted as an area of supply or resistance. Whenever price reached this zone, price came back down, price came back again, came back down, came back to it again, reacted downwards. These three times price reached here presented a trading opportunity for people looking forward to sell the market. Okay, let's also identify region of demand, a demand zone. For your key levels to be verified, to be, you need to see price reacting there at least twice for it to be a valid key level, for it to be a valid support or resistance. You need to see price reacting in that zone more than once, at least two times, three times, like we have here. So let's go and look for a supply level. Okay, we have one here. If you see here, we have a fake out from the level, but like I said, the level is more like a region than just the line. So you look for confirmation before you enter. You don't just enter exactly here. You have to look forward to something. You're looking for a price reaction right here. And why this helps you with your risk management, we have what we call your risk reward ratio. Let's say you're taking a trade from this region now, and you're setting your stop loss right below the level because you don't expect price. But see here, if you were to do the same thing here, you would have been stopped out. That's why you should also look for confirmation. So here we have your tool, your position tool. This is a long position tool, and we also have a short position tool. Here it is. So let's place this here. So your short position tool, you're looking to sell from resistance and buy from supports. Excuse me. You're looking forward to sell from resistance and buy from supports. Okay, now let's go so we can proceed to our reward examples, support examples. A stock consistently finds support at $100, meaning every time the price reaches 100, it bounces back up just like we have here in TradingView. Anytime price reached, anytime gold reached 1,688, then tends to bounce, even when it had a fake out. When it came back in, it went up. So resistance examples, we have similar thing. A cryptocurrency struggles to break above 30, indicating strong selling pressure at that level. So now, common mistakes to avoid: ignoring the impact of market news and events on key levels. You do not want to. That's what I told you. Both technical analysis and fundamental analysis work hand in hand. You want to use both of them to execute your trade. Excuse me. Yes. Chukwuemeka, you have a question? Okay. Uh, please leave your questions in the chat box and call message right here. And also remember to fill the attendance form because we have a surprise for you. The this PDF that this material, this teaching material that we're using to teach is going to be emailed to you for your use after this session. So moving back on to our class. Another common mistake to avoid is over relying on a single key level without considering the broader market context. This is what I was saying, that you are saying price come to your key level, whether support or resistance level, and you just execute a trade without while ignoring how market is actually approaching that level. So another mistake is failing to account for false breakouts when price temporarily move past a level before reversing. And we have a perfect example here. By the time you see this here, you say, no, this level, it's not. Are you sure it's actually a demand level? No, my demand level is meant to be 100%. Anytime price get there, it bounce, making trading look very simple. But if it was that simple, we would all be rich. So here we have a pattern. Actually, we have, when we get there, we have a pattern, a triple bottom pattern here. And this could act as your confirmation back into back into buying from this your demand zone. So these are things you'd like to see when price gets to your demand zone, as well as your candlestick formation. Your candlestick formation. So let's move on to candlestick formation here. Excuse me. Move on to candlestick. Candlestick and chart patterns. Candlestick patterns are visual representations of price movements with a specific time period. They help traders understand market sentiments and identify potential trading opportunities based on historical price behavior. You see this keyword, historical price behavior. We are looking at previous price data. We're looking at the entire chart we're looking at is a sheet of data. What has happened before? You have to know what have happened before in order for you to make predictions. Like, you don't ignore the past when it comes to technical analysis, when it comes to viewing your charts. That's why a lot of traders backtest a lot. You go back a year ago and see how price reacted to a strategy you are using to trade. It is very important. Historic price behavior. You do not ignore the past. So we have structure of candlesticks. We have the body. This is the body, like here. This is the body. This is an example of your candlestick. We have the body represent the open and close prices within the chosen time frame. As you can see, price close here, price open here. This is a bullish candle. Price went up in this candlestick. Then this is a bearish candle because you can see the open is above the close. So price opened here and went down and closed here. So this candle went down, as you can see. Here, price opened from this bottom here and closed above it. So price actually made a movement upward in this candlestick. That's how you determine the kind of candle, the kind of candle you're looking at. This is a bullish candlestick and this is a bearish candlestick. Some people, if the chart now was all one color, how you would, if there was no difference in color like black and white, green and red, this is to help you identify what you're trading, what the candlestick is saying. Aside from color, you'd want to see, you want to be able to identify the close, the opening price and the closing price. Because even before all this technology, before technological advancements, all they could see was one color and they could still trade far better than some of us today. So we have the wick or the shadow, the thin lines above and below the body representing the high and low prices. So now this is an example of your week, or we call it shadow. Here, upper shadow, and right here, lower shadow. They are your week. Then color, green or white candles indicates a price increase, bullish, like we discussed. While red or black candles indicates a price decrease, bearish. But mind you, you can decide to switch your candlestick colors. Your white candle can be identified as a bearish candle in your chart, and I'll show you all that right now. Let's move. Let's go to trading view, because this is we're not just here to talk theory, we are meant to see practical also. So now, what do you see in this candlestick? Where is your opening in this candlestick, this particular candlestick? You can see that price opened right here, but price closed down here. That's what made this candlestick black. Okay, now to show you that candlestick don't actually matter. So let's change our bearish candle to white and our bullish candle to black. Oh no. Let's do this. Let's do this first. Uh how would you know what kind of candle when they are all the same colors? Like I was saying, it is quite obvious here. Price opened here because as you can see, price movements, price was moving downward. Price opened here, closed here, price opened here. This is an indecisive candle. This is a type of candlestick or a doji candlestick. This indecisive candlestick, it it indicates that neither buyers or sellers are in control. But this candlestick indicates sellers are in control because it's opened here and closed here. It even went way down here. This is the wick. This is the shadow of the candlestick. Let's put back the colors. So, like I was saying, you can make your upward candle black, and it's all mindset. Like you can see now, candles going up can be black. So you need to learn how to use your trading view. Knowing how to use your trading view is very important. We talked about indicators previously. This is an indicator. This is my moving average. And how can you get it? You may ask. There's an indicator place here. So here you get to search any indicator you'd want to use. We have the sessions. I can put this any session you want. We have your relative strength index, or you can come here and search different sessions actually. We have technical indicators, community indicators, personal, and favorites. By the time you see an indicator you like, you make it your favorite and it stores here. So instead of you to come and start searching all over again, you can easily find it here. We have a Bollinger Band right here and so many. We'll dive into using of indicators in our upcoming mentorship program. Right here, I'm just going to show you what you can still use to make money, even because I've taught you how to identify key levels, and some people just use key levels to make money, along with the candlestick confirmation I'm going to be teaching you today. So moving back on to our candlestick, moving back to our candlestick. Okay, so basic candlestick patterns. Another edge you need to have while trading. We have the hammer or the pin bar. Here, let me zoom properly. Here you can see this. This is the hammer candlestick. What does the hammer indicate? You can see closing price is above and opening price is below. That is, this week now represents price rejection, price reaction. Here, this hammer candlestick indicates that buyers are in control, and that is why this is a bullish pattern among candlesticks. This is a bullish candlestick pattern. We have the bullish engulfing. This bullish candlestick completely engulfed, completely wrapped this bearish candlestick. And we have the morning star. This candlestick right in the middle can be indecisive, but the next candlestick should close above this candlestick and close 50% above in cases this bullish candlestick should close above this bearish candlestick by 50%, like 50% of the body of the candle. That's what you're looking forward to, because this is technical analysis. You're actually looking for it. It will not always occur like this. It will not always occur like this. It will not always occur like this, but you would see it. Once you see it, you will know it. Let's go to the bearish candlestick. So we have the bearish stick candlestick patterns. We have the shooting star, which is a bearish pin bar. It's upside down. It's the reverse of the hammer. If you can see right here, this is the hammer, and this is your shooting star, which is the opposite, the reverse form of your hammer. So here, opening price is above closing price, and there's a long shadow indicating price rejection. Here, sellers are in control. In the bullish, here, buyers are in control. Here we have the bearish engulfing bar, and here you see the bearish candlestick completely covering this bullish candlestick. The price opened here and closed here, and we have the evening star, just like we have the evening star, just like the morning star. The evening star, like I said, just like the morning star candlestick now. You want to see price, actually this third candlestick, just like this one, because price is not always going to give you this, because this is actually the opposite of this. So there's a way to actually measure it. You want to see this candle closing more than 50% of this candle's body. If you measure it, you see that from here to here, right here, is more than 50% of this candlestick body, which will then indicate price reversal, because we have both reversal candlestick patterns and continuation candlestick patterns, and we're going to be looking into that. So now let's go to the chart and identify some of these candlesticks. Yeah. Okay. So let's look for our bullish engulfing. Let me give you exactly how it is so you would know what you're seeing. Right here we have similar to the morning stuff. I'm sorry about that. Let's reset this price charts. Okay. 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 We're back. So right here, let's identify similar. Okay. You can see this. This can be identified as your evening star, but let's ignore this right now. I want you to look at this right here. This is your hammer or your pin bar candlestick. Let's put that right in there. So this place right here, you have your hammer or your pin bar candlestick, and we also have your shooting star candlestick, your morning star candlestick. Sorry, let me zoom in properly. And what does, if you can see in this candlestick, there's a confluence actually. You have your hammer indicating upward movement. Remember, we actually changed the color of our stuff. We reversed it. So let's reverse it back. So let me just change it to red and green for easy understanding, because that's what you'd see. Okay, so red means down, green means up. So let's go. Here you have your pin bar candlestick, and these three candlesticks are actually your morning star candlestick. So this, you can see this candlestick now involves price reversal, because price was coming down for a while until this candlestick appeared right here, because this is the last candlestick here. After it appeared, you got this reaction upward. You see that price didn't come down for a while. You can see it here. So identifying candlestick for extra confluence would help you a lot when taking a trade. So now the reason you don't just enter directly from here, you can see that okay, yes, price has bounced on our demand zone. You couldn't see anything, you couldn't see anything to trade right from here, which is no biggie. You have no issue. But actually here we have our engulfing candlestick. Let's take a look at it. Price engulfed the full body of the candlestick right here. So let's say you missed this. There are going to be plenty of opportunities when trading. Let's say you missed this right here, and I'm going to be teaching you how to enter this. So now, when entering this, let's just use this position to right here. When entering this, your price close right here. You're going to be looking for placing your stop loss right beneath here after this confirmation candlestick, and your targets, you should have a target of 1:3 or 1:2 depending on how far you want to stay in this trade. But now let's target 1:3, and if you, as you can see right here, it's a target of 1:3. It's actually played out. Your stop loss was right below the bullish engulfing candlestick. Why was it below it? Because you didn't expect price to actually come below here, because you see this bullish engulfing stick right on your key level. Here we have an inside bar candlestick, but we're not teaching that now. We're going to shed more light on that in our mentorship program coming up. Okay, let's reset this chart. Let's look at our, okay, I also reset the color. Sorry about that. Okay, so zoom down. So back to our shooting morning star. How can you trade your morning star candlestick? These three patterns here, if you can see it clearly, it looks just like the one over here. Ignore this middle candle, because this middle candle is meant to either be, it can either be a pin bar candle, which is your hammer, like this right here, or it can be an indecisive candle, or it can be just like this. So what we are looking for is price. This third candle actually closing above 50% of the previous candle, the bearish candle. So let's go back to the charts. How do you trade this? Even with just support and resistance, you can make money. So now you have seen price react from your supply zone. Let me remove this line so it doesn't confuse us. You're seeing price react from your demand zone. Sorry about that. That was a mistake on my end. And now you're looking to take trade. You've missed this one, but there's still an opportunity, because this right here is your demand zone. You're seeing nice price reaction when price is approaching this zone. Okay, now you're looking for something. What trade will I take now? Okay, then this candlestick appears immediately. It sweeps this low, which we're going to be talking about sweeps also. But right now, I'm going to teach you a fundamental you can actually start using to make money in the market with proper risk management. You have to have risk management, not just hopping in any trade. So now, this third candlestick, you can see it close above 50% of this candlestick right here. You can see it close above 50% of this candlestick body right here, and that is okay. So now, how do we trade this? Usually, we would wait for price to retrace down to the body. That is, you don't just enter at the stop, you wait for price retracements. Like I said, patience is key. Patience is key in trading. And what kind of retracement are you looking for? You're looking for a retracement to like, no, let's not use the Fibonacci tool. Let's use our rectangle tool. You have different tools here in TradingView. We're going to be teaching you how to use different tools in our upcoming masterclass. That's in June 6th. Registrations are still ongoing. So now, how do you trade this exactly? You've seen price reacts from your key level, which is your demand zone, which is right here. You missed this initial trade. Now you've seen another trading opportunity with this your candlestick confirmation pattern, which is your morning star candlestick. So now you don't just enter once price close, you wait for price retracements up to 50% of this body of the third candlestick. At least 50% of the third candlestick. So now from there, you place your trading tool. Note your stop loss is always meant to be below this middle candlestick because that was the last candlestick that confirmed the pattern, and you target 1:3, which is a no-brainer in trading. 1:3, 1:2. But yeah, we stick with 1:3. Now you can see you've made, let's say you're risking $5, $2 on each trade. By the time it actually hits your take profits, which is this high, which is reasonable because you target highs, you put your take profits at highs and lows for expected take profits. And we're going to be teaching you that also in our upcoming masterclass, in our upcoming mentorship program, how to determine where to take profits, where to put your stop loss. I just showed you how to put your stop loss or where to put your stop loss when trading candlestick patterns. So now, if you risked, I'll also show you position sizing. So now you want to risk, let's say $3. You Let me show you how to do this. You come here, you double tap your position tool, you put in the amount you want to risk. Let's say $3 in this case. Sorry, excuse me. Let's say $3 in this case. You confirm that you see the quantity. Oh yeah, that's for crypto actually. In Forex we have pips, and this is a gold chart, and the pips are way higher. So I'll use another example for that. So yes, right here now, after setting your risk, you know the lot size you're going to look at, the lot size you're going to use, and we'll dive into that. So right here, after placing your stop loss below this candlestick and your entry at the 50th percent of your your bullish candlestick right here from this three candlestick pattern, which is your morning star. Let me use another shape to identify it. Uh, okay, yeah, let's use the circle. You need to learn how to use your trading view. Very important. So these three candlesticks right here, very important. So moving on, right here, you would have made money by just knowing how to trade your support and resistance with confirmation, along with confirmation with your candlestick patterns. Very, very important. Uh, Sorry. So moving on, common mistakes to avoid while trading chart patterns. Ignoring the overall market trend when analyzing patterns. Over relying on a single pattern without considering other indicators. Misinterpreting similar looking patterns, e.g., hammer or shooting star. If it's not there, it's not there. You have to see price rejection like this. You have to see a nice weak rejection when identifying your hammer or your shooting star. If it's not there, it's not there. You're engulfing. Why it's called an engulfing is because the second candle completely covers the body of the previous candle. Forget about the wick. The it's called engulfing because the body of this candle cover the body of this candle. That is why it's called an engulfing candlestick pattern. So now moving on to leverage, lot size, and spread. Like we discussed, like I mentioned previously, leverage, lot size, and spread are fundamental concepts in trading that determine your trade size, your risk, and potential profits. As you can see, previously I wasn't able to explain the risk size properly because we've not touched leverage, lot size, and spread. So the key thing here is your lot size. Leverages are mostly used in crypto trading. Like in crypto trading, they have leverage. In forex trading, we also have leverage, but your leverage is determined by your lot size, and the lot size is more important. So we have the lot size, and the spread. My colleague will be teaching you the leverage for crypto tomorrow. So we're going to touch lot size. Lot size refers to the volume or quantity of the assets you are trading. Common sizes include standard lots. We have one lot size, which is, let's take a look at our Meta 5. Yeah, looking at our Meta 5. Okay, so in Meta 5, we have different lot size. I'm going to show you how to use this tool called Meta 5 Trader. Yeah, I'm going to show you how to use it. So for today, the Forex market is closed, but we are going to be trading synthetics. Right here, we have our menu in our Meta 4, Meta 5. We have the settings where you can set your charts, you can set your sound, your notifications, you can join a trading community. Then we have contact developer. We also have accounts. Here in your accounts, we have different brokers. We have, right, today we're going to be using Deriv demo accounts. I've already created the account, but if you'd like to create or have a demo account, you simply, these are the steps. You come to your accounts, you come to this plus size, you find your broker. In my case, I will have to search. In your case, you have to search, but me, I didn't have to search because I already used Deriv. Search Deriv, it will come up. You tap on it. Make sure you select Deriv demo, then open demo accounts. You fill in your details, you accept the terms and conditions, and you press register. Immediately you press register, you're going to have a demo account just like I do right here. So what's the importance of demo accounts? Before you start trading with your money, your real money, you have to practice simulations. You have to practice what you have learned so far. So let's say today, okay, I'm going to also show you how to, okay, let's finish identifying the tools. We have the mailbox, we have the messages where Meta 5 messages you whether your trade has hit your take profit or your hit your stop loss. We have mailbox also from Meta 5 telling you your risk warning. News. I think you have to join a community for that. We have quotes. These are your quotes, different pairs. So now, as you can see in our demo account, we have total deposit of $100,000 and we have a balance of $100,000 of demo currency. You cannot withdraw this. It's only for trading. It's a dummy currency. You use it only to practice. So then here is where you monitor your trade. if you're in a current trade. Here you have your charts where you look at your charts, then your quotes again. Sorry. So let's get back to adding, let's say we have different currencies to trade. Right now, I think our volatility market, excuse me, right now, I think our volatility market is still open. So let's say you come to your quotes here, you can't see any volatility, or you're looking for a particular pair. Let's say you're looking for your GBP USD, you search it GBP, or instead of searching, you can actually come to Forex Major and you would find your GBP USD here. We have the exotic pairs, we have the major pairs. The major pairs are paired with USD. So you come here, you click add. By the time you add, scroll down, you'd see your GBP USD and it will open up the charts. Sorry, excuse me. Okay, sorry about that. Back to this. Uh, okay, so today we are going to be using volatility indices to trade. I've already added the volatility 10. There are different volatility indices, and sometimes they are called synthetics actually. So let's go to volatility 10 because the Forex market is closed. The Forex market is only open 24/5. That is open 24 hours for 5 days of the week, the 5 working days of the week actually. So right now, this is our volatility 10 charts, and we have two ways of executing trades. We have the limits right here, and we have the markets. So let me explain what the limit and market is. Okay, first let me show you what lot size is. So right here, there's a standard lot. This is where you place your lot size. The standard lot is $1. So the standard lot is 100,000 units. That's $100,000. One lot size equals to $100,000. 0.1 lot size is equals to $10,000. And 0.01 is equal to 0.01 is equal to $1,000. So what does lot size actually indicate for us as traders? Lot size, lot size indicates the quantity of the assets we want to trade. So the lot size with our margin, because you need a required margin to be able to open a specific lot size. So what I'm saying, your standard lot size, which is one, is 100,000 units of $1. Then mini lot size 10,000 units, $10,000, and micro lot size 1,000 units. So now we leverage the lot size with our margin to be able to open a trade. So you want to open a trade with 0.01 lot size with your margin, it gives you leverage to open a position of $1,000. And that $1,000 now, because in the Forex markets, let's say the GBP USD now, price actually moves in pips. Let's go back to trading view and let's go back to GBP USD. I want you to see something. Price actually moves in pips. Sorry about my charts. Okay. Let's let's stay here. Let's go to 1 hour. Let's look at the previous trade that was taken right here. Okay, right here. Sorry about that. Right here, if you can see this trade now, we have the risk. Our risk, which is our stop, is 17 pips, 17.1 pips, and our take profits, which is our target is 68.4 pips. So when you divide 68.4 with 17.1, you get 4. So that is your risk reward ratio, which is showing right here. That is, you're risking 1 to get 4. Like you're risking this 17 pips now in order to get a profit of 68 pips. So this 4 times 17.1 is going to give you 68. Okay. So now, because the forex market moves in pips, you want to have leverage with your lot size and your margin, whereby you open a position with $1,000. And we have our pip calculator. Let's take a look at that. Let's take a look at our pip calculator. You can get your pip calculator in your browser. Pip calculator. So now, this is FXTM. Okay. So now, one pip, what does it represent? What does one pip represent? Okay, one pip on the lot size 0.01. Calculates. One pip represents 10 cents. For every one pip movement, you get 10 cents. So let's switch this to GBP USD. Sorry, come to Forex. GBP USD calculates. We know this for one lot size. For one lot size, one pip movement equals to $10. So if you were to use one lot size over here, so your you have 17.1 pip, and that represents 17.1 pip represents your stop loss. So if you calculate it now, one pip equals to $10 if you're using a lot size of one, and one represents $100,000. So now if we should calculate that with our calculator, so that would be 17.1 times $10. You'd be risking $171 for your stop loss. Then times 4 would be your target profits, $684 for opening a one lot size position. But let's break it down to a lot size that is actually practical, because not a lot of people have $100,000 accounts. Uh, back to our calculator. So 0.01 calculates. That would be one pip would be 10 cents. Then 17.1 pip would be what? Your risk would be $1, 1.7, $1.71. Then your profit was 68. Sorry, 68 points. Yes, 4. Calculates your profits was $6.84. That's just for beginner levels. So right now, what I'm showing you now is a tool you can use to calculate. A tool you can use to do your risk management. You don't have to be a mass a math genius. You can simply come and put in your inputs here and calculate everything you want to use for your risk management. So back to executing trades in our Meta 5. Today we're going to be executing a trade in volatility. And what are we going to be doing here? Each pair in volatility actually has a minimum lot size. Like we can't go below 0.5 here. The minimum lot size you can use is 0.5. We have the different time frames from the 1 day to down to the 1 minute actually. So if we were to take a trade here in 1 minute time frame, this symbol indicates markets to execute your trade with current market price. And these two lines right here, let's take a look at it. This red line and this green line indicates your spread. And what is your spread? Your spread, this is the difference between the buying ask and the selling bid price of a financial instrument. It represents the broker's fee and can vary depending on the market condition. So yes, right here, these two lines here, which price is in between, if you can see, represents your spread. It's very important to take note of your spread. Very, very important because some brokers actually have, some pairs have, different pairs have their spread size. So for now, let's say you want to execute a sell, you come here, you have to accept your terms and conditions first. Why is it executing a sell? Okay, I'm seeing this rejection. Okay. By the time you hit sell and come to trade, you'd actually see your position right here. It's executed right immediately you click. The amount of times you click it, the more trades are executed. Then we also have how to place our trades in. We have how to place orders for our trade. We have the market execution. We have the buy limits. We have the sell limits. We have the buy stop, sell stop, buy stop, sell, and a lot of these, all of them are going to be explained later on. So moving on back to our class, risk management in trading. Risk management is key to long-term profitability, and that's the truth. Without risk management, you're just gambling. Risk management is the process of identifying and assessing and controlling potential losses in trading. It helps traders protect their capital and stay profitable over the long term. Stay consistent with your risk, stay consistent with your profit targets, divide your entire equity into your win rates. That's risk management in trading. And among risk management, we have different strategies. You can draft a strategy that works for you depending on your account size. But right here, we're going to be drafting one for $100 size. And it says, for instance, you know yourself that you can't lose 12 trades. Let's say you become an expert. Out of 20 trades, you win, let's say 18, you win 12. Out of 15 trades, you win 12 on a stretch, and you have an account of $100, you divide the $100 into 12 trading opportunities, meaning you're going to be risking 8.3 per trade on the $100 accounts. So it's going to take you 12 losses to lose that entire account. Your capabilities are 12, and you know you can't get 12 consecutive losses. What you've done is dividing your entire equity into your win rates, which means in between those 12, you can get win rates anytime. Staying consistent with your risks. For example, you are risking 8.3 and you have a specific target of 1:3, like we discussed previously, or 1:3, each time you risk 8.3, you are expecting a profit target of $24. Anytime you risk $8.30, you're expecting a profit, a target profit of $24.90. So you are either going to lose $8 or you're going to win $24. Meaning if you lose $8 three times, it takes you just one win of 1:3 to bounce back, break even. That's risk management for you. Risk management help you. Let's say losing is inevitable, but how do you stay profitable in this trading career of yours that you're about to stay? You have to have a very good risk management strategy, just like this one right here. As you can see, you might you might lose $8 three times, but one good trade will bring you back to break even. and let's say you've won trades consistently, that is 25, approximately $25 times three. When you do the maths, and okay, let's do the maths actually, because this is supposed to be very practical. You win three trades, you win three trades, that's $75, and you lose three trades, minus your 75. Sorry, 75 minus 75 actually. Let's just 75 minus 25. You're still profitable with $50. Okay. How the trades you win and how the losses for your $100 account now. Let's say you actually lose three trades consistently and you end up winning um three trades consecutively, sorry, then you have a $50 profit. You are not in break even, you are actually still profitable. So out of six times you traded, you lost three times and you profited three times. You are still in profits. That's all risk management is about, keeping you profitable in the long term. So back to our risk management. Consistent risk of $8.30 consists consistent profit of 1:3. If you lose $8.30, one win is giving you top two on top your previous loss, times two of your previous loss and recovering your previous loss. Then if you lose three times, one trade is recovering your previous loss, taking you back to break even. So having a risk management strategy is very important for a trader. And as a trader, you need to document your trades. You need to have documentation. Following, always ensure you follow your risk management strategy. Okay, so buying and selling in the forex markets. We just talked about that. We talked about, okay, in the forex market, trading one fiat currency against another, e.g., USD, Euro. You don't own physical currencies. You are speculating on price differences. That's what you're doing in the forex market. You don't actually own these currencies, unlike in the crypto spot market. When you buy one Bitcoin, you actually come to see one Bitcoin in your wallet. And my colleague is going to dissect every bit of that in our lesson tomorrow. So now, when buying and selling, we have the market order and the limit order, and that's what I showed you here in our Meta 5 right here. We have our buy limits, our markets, buy and sell limits, and our market execution for buying and selling also. And that's all we did here. That's all we did here. So back to okay. So a command to buy or sell immediately, that's your market order. As you could see when I tapped on buy, excuse me, it immediately buys immediately, doesn't waste time. When I tap on sell, it sells immediately. But in limits, what does limits say? In limits, you set a price at which you are willing to buy or sell from. That's why we have the buy or sell order in our Meta 5. This is useful when you want a better entry or exit point. For example, let's say BTC, you want, because you can actually trade BTC in your Forex markets. Provisions have been made to trade cryptocurrencies also. Excuse me. So you just come to your Meta 5, look for crypto and search for BTC, and you see it right here. BTC USD. Let's go to the chart since the BTC market is still open. Okay, so now this is the BTC charts. This second tool that I didn't dwell on is actually for opening limits. So by the time you tap on this circular tool, you come, let's say you want to sell BTC right from this point here. Then you set your stop loss above here, set your take profits right here. You can take it further down if you want. Let's say here. So now the lot size also applies here. You have to know how to calculate your lot size for BTC. With your pips calculator, you don't have to do everything with your head. There are tools provided to make your trading experience easy. So now, by the time you've set all that, it's automatically applies here in the sell limit order. And what do you do next? You place your order, and your order is placed. So your limit order is used. Your limit order is used for when you want to enter at a better price. You can't if you don't want to sell immediately, if you don't want to buy immediately. Okay, okay. So we've come to the end of our technical analysis in the Forex markets, and we've been able to touch a lot so far. And with just these few things, you can actually start practicing with your demo accounts. We've been able to touch these tools, our Meta 4, Meta 5, and our trading view. And as you can see, we touched these topics: technical analysis, supports and resistance levels, candlestick and chart patterns, leverage, lot size and spread, risk management strategies, buying and selling on spots, balancing potential gains and losses is also what we saw in our risk management. By the time you have a win rate of, let's say, um 3 out of, let's use you trade 6 times, you lose 3 trades in between or consecutively. When you lose 3 trades in between or consecutively, you're still going to lose using our strategy right here. You're still going to lose about $25. And when you win about 3 trades out of 6 in between, you're also going to win $75. And by the time you balance your wins and your losses, you see that you're still profitable. That's why you have to have a risk management strategy. You're risking this amount and you have a target of 1:3 for that amount you're risking. So your one representing your $8.3 and your three representing your target profits. So 3 times the $8 you're risking in your trade, that is your target profits. So when you have these risk management strategies set out by dividing your total accounts into different opportunities, into multiple trades, like dividing your $100 accounts to take 12 trades. That is, each of your risk size will be $8.3, and that's what this strategy is explaining. You can also divide your $100 account or any amount, your $50 account, into 10 trades, into 50 trades, as many as you want, and as many as much as you are comfortable with risking, because the amounts you are risking over your trade, it has to be something you are willing to risk, so your mind wouldn't be scattered over the place by the time you see price going against you, or by the time you see price going in your favor just a little bit, you already feel overwhelmed, and you're 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 telling yourself you should take it. So risk management strategies actually help in building your trading psychology. It is very important, and they also help in balancing your wins and your losses. So that's what we have learned today, along with other technical analysis too. So after the class today, I would like you to actually download TradingView and Meta 5, and just like I showed you, you could actually own your own demo accounts and start practicing with some of these things I have shown you today. And this PDF, this material we used to teach, is actually going to be sent to your emails. That's why it's very important for you to actually fill our attendance form. So, okay, now at the end of the session, we're going to be taking questions. Chukwu Ebuka, you have a question. Please, admin, help me unmute Chukwu Ebuka. Hello.
Good evening, sir.
Yeah, good evening, Chukwuebuka.
I don't really have a question.
Yeah,
I don't really have a question.
okay, but your hands were up.
It was a
Is there a
mistake, sir. I
contribution?
didn't know. I didn't know.
Okay, okay, okay. Then you can go ahead in meeting. Thank you. All right, we've come to the end of our session today. We're going to be having another session tomorrow for our campus tour continuation, where we're going to be showing you how to execute trades in the cryptocurrency markets. And we're going to be making use of either our Bybit or Binance. And it's going to be a very exciting parts of our journey in this campus tour. So looking forward to seeing each and every one of you that was able to join in today. And thank you very much for your time. And I hope I was able to get some knowledge across to you. See you tomorrow.